Well, let's start with the market action for the day. We saw a late recovery and that helped the Sensex and the Nifty close in the green. The Sensex gained nearly 150 points. The Nifty added 60 points. Bank stocks saw some profit booking and the Nifty Bank Index ended in the red. The Sensex and the Nifty have posted gains for the third straight week. In fact, in the last 3 weeks, the markets have gained more than 5%. So it continues to be a sea of resilience as far as our markets are concerned. On the earnings front, pharma major Cipla reporting a strong set of numbers in Q2. The company's net profit has come in at nearly 790 crores. That's up almost 11% year-on-year. Revenue stood at 5,800 crore rupees, up nearly 6% year-on-year. Margins also expanded to 22.3%. Watch and jewelry brand Titan's Q2 numbers came in above street estimates. The company's net profit came in close to 860 crore rupees, up nearly 34% year-on-year. Revenue was up almost 22% at 8,700 crore rupees. Management says retail growth stood at 17 to 19% this festive season compared with last year. Now, Vodafone Idea's losses have widened to nearly 7,600 crore rupees in the second quarter as the telecom company continues to incur higher expenses amidst a dwindling subscriber base. Rima joins us now with a health check on Vodafone Idea. The company is still waiting for clarity on when the government intends to convert its debt to equity. Take a look.
Thanks so much for that. So the revenue growth for Vodafone Idea was pretty healthy at about 2%, but margins have contracted by 300 basis points to 38.6%. That, coupled with a big finance cost, has driven a large loss in the bottom line. So the bottom line loss stands at 7,500 crore rupees. The problem for Vodafone Idea is that it's losing subscribers every single quarter. This quarter, it lost about 6 million subscribers on a sequential basis. Compare this with peers, which both managed to report a subscriber addition. On a year-on-year basis, their subscriber base has now fallen by 18.5 million subscribers. And this even as the company continues to spend more to acquire customers. Their marketing cost has been going up quarter after quarter. If you look at the marketing cost this quarter, it was about 1,100 crore rupees, which is a good 68% higher than what it was same time last year. But that's not resulting in any, subscriber addition. Net debt continues to balloon. 2.2 lakh crore is the latest figure, as a result of which its finance cost is more than 6,000 crore rupees. So if you annualize the finance cost, we are looking at a number of 24,000 crore rupees, which is roughly 90% of the company's market capitalization. So debt losing subscribers is a problem for the company. Back to you.
Rima, many thanks for joining us. Tough times continue there for Vodafone. Meanwhile, FMCG player Marico's Q2 earnings in line with estimates. Net profit is down 2.8% year-on-year. Revenue growth is at 3.2%. EBITDA grew by 2.4%. Margin grew at 17.4% versus estimates of 17.5%. In the IPO corner, BKG Foods issue is fully subscribed on the second day with a strong response coming in from retail investors. The retail book was subscribed over 1.7 times as of 3 p.m. The HNI portion was subscribed 67% of the total allotment. The company is looking to raise over 800 crore rupees. And staying with IPOs, Fusion Microfinance public issue was subscribed 1.4 times on the last day of the offer. Retail portion has seen a tepid response with only 42% of the book being subscribed. HNI portion was subscribed 1.26 times of the allotted quota. Moving on to a CNBC-TV18 exclusive, the government's disinvestment drive is likely to pick up some pace. Sources tell CNBC-TV18 the government is planning on divesting 3 public sector enterprises over the next 4 months via the offer for sale route. Yash joins us now with more. Yash, take us through the companies that will be part of this disinvestment process.
Well, that's correct. We do expect a pickup when it comes to the OFS process from PSU enterprises or PSU companies. What we've been given to understand from our sources is that government is likely to focus on 3 important OFS issues on the PSU side, and these 3 are Coal India, Hindustan Zinc and Rights. Do remember, at this point of time, the government's target for divestment for the current financial year was about 65,000 crore rupees. 24,000 crore has been raised. So this next set of OFS process will help the government reach closer to that target. If I just had to give some details about the OFS issues, then Coal India, that is expected to be around 5,000 crore rupees, an equity dilution of about 3% of government stake in the company. Hindustan Zinc, that's a big one, about 10,000 crore rupees, up to 8% government stake in the company. And finally, Rights, that's also a 1,000 crore issue, but it translates to up to 10% government stake in the company, which may be eligible for this OFS process.
Yash, many thanks for joining us. That is a CNBC TV18 exclusive. But the big global story, days after Elon Musk took charge at Twitter, reports suggest the company will prune its workforce by as much as 50%. Now, in an email that's been accessed by many, including CNBC, this was sent to staff last evening. Twitter has said that they would notify the staff of their employment status by today. Musk has already fired the Twitter board and several top executives, including the CEO and the CFO. Reports say that a class action suit has been filed against Twitter, alleging that the company was sacking staff without adequate notice. The current economic conditions are forcing several tech companies in the valley to tighten their belts, and Indian tech companies are not immune either. Abhishek Dattaroy decodes the new phase of tech austerity across the world. Elon Musk, Twitter's new owner and its complaint hotline operator by his own admission, may not want to take frantic calls from employees as his company starts implementing cost-cutting measures. As per reports, Twitter plans to lay off close to 50% of its staff starting today, ticking off yet another item on Musk's to-do list. Reports of imminent layoffs have been doing the rounds ever since Musk took charge of Twitter. An internal mail addressed to employees last evening read, and I quote, "In an effort to place Twitter on a healthy path, we will go through the difficult process of reducing our global workforce," end of quote. The email also says staff members will get notices either through their company email accounts if they still have jobs, or their personal email accounts if their employment is impacted. Twitter also forbade employees from discussing confidential company information on social media. Twitter is only adding to the wave of layoffs across tech companies in the Valley and across the world. A host of others, including ride-hailing app Lyft, online real estate company Opendoor, fintech companies Stripe and Chime, are also handing out pink slips. According to the San Francisco Standard's layoff tracker, more than 16,000 workers have been laid off at 138 San Francisco-based companies since January of 2022. Many of them happen to be tech companies. So why exactly is the tech ecosystem pruning its workforce, tightening its belt all of a sudden? A quick glance at emails sent to employees by some of these companies, and there is a commonality. Companies are bracing for a recession in the US, pulling out of less critical initiatives and trimming their outlook on growth prospects of the internet economy. Back home, after Byju's fired 2,500 employees in a bid to target to turn a profit by March next year, the company's founder Byju Ravindran said this is a huge price to pay for walking on the path to profitability. But this hasn't deterred the nation's largest edtech firm to announce that they've onboarded Lionel Messi as their global brand ambassador for equitable education social initiatives. The company has not disclosed how much they had to shell out to sign the football superstar. Byju's isn't the only company cutting jobs. Unacademy has laid off more than 1,000 employees. White Hat Junior, Vedantu, Lead have all announced job cuts. Even big tech is struggling. Shares of Facebook's parent, Meta, are down more than 75% from record highs. Amazon has imposed a freeze on corporate hiring as the global outlook for economic growth remains grim. The tech industry is certainly tightening its belt across the board. With Abhishek Dattaroy in Mumbai, this is Shireen Bhan. And staying with the global risk aversion that we are seeing, Tiger Global-backed startup Unicorn ChargeBee has laid off 10% of its workforce as it restructures its organization amidst growing operational debt and global macroeconomic challenges. That's not all. Tiger Global has halted its investments in China's equity market. A Wall Street Journal report says that the company plans to reassess its exposure to China after President Xi Jinping has now secured himself a historic third term. A setback for India's fintech industry. That's the first word in from Builders co-founder on the aborted $4.7 billion deal with PayU, which would have been one of the largest fintech deals in the country. Speaking with CNBC TV18's Ritu Singh, BillDesk co-founder Srinivas Eman says the termination of the deal was, and I quote, a disappointment, adding that this will create a trust deficit on how Indian companies view foreign investors. Take a look.
Yes, it has been, I think, a disappointment for the industry, and I think it's also been a setback from a fintech industry perspective of what would have been a large deal and the manner in which it was perhaps called off. So we'll just have to wait for time to see how this evolves.
Do you think it'll have a wider ramification than just one deal falling off for two set of players?
I would think right now the bigger implication is for how does any entity transacting in an M&A deal rely on a buyer of that nature to stick to the deal. I think that's a bigger ramification than saying, how do people look at India? I don't think that's impacted. India did its job in terms of regulatory clearances to asking the right questions. So I think the implications are more from how do Indian companies look at foreign investors sticking to their word.
And there's plenty more from the startup space. Car-sharing platform Zoom Car has announced that the company will go public through a special purpose vehicle company or a SPAC. The company will be listed on the Nasdaq Stock Exchange, and the official merger is set to be finalized by the second quarter of 2023. So Zoom Car being listed through the SPAC route. GE Aerospace and Tata Advanced Systems have extended their $1 billion contract for the production and supply of engine components of commercial aircraft. The contract was first signed in 2017. The parts will be manufactured at the Tata Center of Excellence for Aero Engines. Reliance Retail is planning to enter the salon business and is in final stages to buy 49% stake in Natural Salon and Spa. The existing promoters of the salon chain, Groom India Salons and Spa, will continue running its operations. Reliance Retail's investment will help the business expand. Now, the European Securities Market Authority, that's ESMA, has disqualified 6 Indian clearing companies, including CCIL, ICCL and NSE Clearing Company. Now, this means foreign banks who report to the European regulator cannot use the facilities of CCIL and other clearance companies to settle trades on foreign exchange, derivative, government and bond securities. Lata joins us now to explain the implications. Lata, why have these companies been disqualified and what is the likely impact?
I want to state at the outset that this disqualification is more a disability to European banks working in India rather than a major disability to any of the clearing corporations. But let me first narrate the story. ESMA, which is the European Union Securities Markets Authority, has disqualified all the Indian clearing corporation companies as counterparties. That is CCIL, ICCL, the NSE Clearing Company, and a few others. The reason that they cite is that the ESMA, under its rules, should be able to supervise all these counterparties, these clearing companies. Or they should have entered into a cooperation agreement with the regulator who regulates them, in this case, RBI, SEBI. Since the ESMA has not entered into any cooperation agreement, these companies are disqualified from being counterparties to any of the European banks, any of the European entities. That's the decision they have taken. Now, I just want to tell you what is the Reserve Bank point of view. I spoke with Mr. R. Gandhi, who is the former DG of RBI and currently non-executive chairman of the CCIL. Mr. Gandhi said that this is an ongoing problem. Consultations are on between ESMA and RBI. The RBI's principal stance is in all cases, whether it is NSE, exchanges, all country regulators believe that, each domestic regulator should regulate domestic entities. If RBI certifies that CCIL is well regulated, it is well supervised, then the European regulator should respect that certification. The consultations are on. As of now, the ban starts only from April 30th, the disqualification, April 30th, 2023. Now, what is the impact of the ban? Impact of the ban is, like I told you, all the European banks, say Deutsche Bank or BNP Paribas, all these banks which are in India cannot deal with CCIL as a counterparty, which means the netting advantage you get. What is the advantage? CCIL acts like the exchange for bond market trading, fixed income trading. Now, if they want to buy or sell bonds, they have to do it bilaterally with an SBI or an ICICI or an HDFC bank. They can't do it with the exchange, that is CCIL. To that extent, the banks lose business. Also, they have to keep more capital when they have to deal with counterparties like, SBI, HDFC Bank, etc. So the disability is to the banks, and therefore these banks are trying to speak to their own regulator. That's where the story stands now. The expectation is that by April 30th, RBI and the ESMA will probably reach some kind of a cooperative agreement.
All right, Lata, thanks very much for explaining this to us, the implications of what this disqualification means. We will head into a break, but up next, the Kejriwal government in Delhi bans all diesel cars except BS6 compliant vehicles as air quality worsens. That and more when we return.